Welcome to Retirement with Rick. I'm your host, Rick Rodriguez, SVP and Retirement Mortgage Specialist at VIP Mortgage. Today, I have the pleasure to introduce Greg Griffin from Griffin Advisory Services. Greg is an investment advisor, and his firm specializes in a variety of financial services, focusing on retirement planning, income strategies, legacy planning, and insurance solutions. For over 32 years, he has helped clients navigate the complexities of transitioning from active income to retirement income while offering solutions to ensure financial stability throughout retirement. His services also include tax advantage strategies using retirement accounts like IRAs and 401ks, as well as legacy planning to ensure assets are effectively passed on to beneficiaries. An Slott Master Elite IRA advisor. Welcome to the show, Greg.
Well, thank you. That's a mouthful right there.
Well, Slott Master Elite IRA advisor. I mean, that's a mouthful. Tell me, that seems like it has some power behind it. Can you tell me a little bit what that is and how that comes into play into your practice?
Yes. Slott is probably one of the largest tools that I use to keep myself in the forefront of the different strategies and products that are being used out there for the retirement, for people in the retirement area. Slott, I joined back in 2008, so I've been with him for 16 years. But his specialty is working with retirees and what we call forever taxed money. Monies in 401ks or retirement programs for companies that are for profit. 403B plans are companies that are nonprofits, church, educational, schools, government type employees, or just the IRAs, which again is a deferred program where we get to put all this money in before it's taxed, and it gets to grow for decades and decades without taxes. But as we start to take that money out, now we're having the tax implications of adding that money, and how are we going to use it efficiently in our retirement in a way that it won't run out and it will give us an income that will be there for our life.
Right. That sounds like a very important aspect. How many people throughout the country are part of this Slott Master? How many Master Elites like Greg Griffin are there out there?
We just were together last week in San Diego. I believe there was 340 of us from around the 50 states that came together in San Diego to learn. This last meeting was with all the changes that are now being introduced by the government on retirement accounts. A lot of people are just not really aware of all the different policy changes that have been going on in the last several years. And when I talk about that specifically, I'm talking about the Secure Act of 2020 or the Secure Act 2 of 2022, where they took away the stretch IRA for our children. Now our children have to pay all the taxes in 10 years, or most of the children have to pay the taxes in 10 years, especially when they're in their high wage earning life or part of their life. So mom and dad are in their 70s and 80s. The children are in their 50s and 60s. They're at the top of the wage. And now all of this IRA money comes from the parents, and it's all taxed while they're having the income coming in. And it creates a very large tax problem.
Yeah. I want to get into some of those policies for sure. Where I want to start, though, is what got you. Tell us a little bit about Griffin Advisory Service and what got you into the business.
Well, for about the first 15 years that I was in the business, and this is going back to 1992, I worked in a larger office. I was a sales manager. I ran a team. We did everything. We did everything from disability, long-term care, Medicare supplements, life insurance, health insurance, and it was very rewarding with all the different people I get to meet. That's the one thing about this business that I just absolutely love, is the wide variety of people out there, from taxidermist to business owner.
Sure.
But since I moved to Las Vegas in 2006, my emphasis has really been strictly on retirees. One thing that most people don't know is that starting 12 years ago in 2012, 10,000 people a day started turning 65.
Right.
Here we are in 2024. Yesterday, 10,000 people turned 65. Today, 10,000 people turn age 65. Tomorrow, 10,000 people turn age 65. And those trillions of dollars that we couldn't touch, now we can touch. And pretty soon, because of the laws with IRAs or the required minimum distributions, we have to start touching every year for the rest of our lives. And that tax infested problem is something that I help people deal with.
Right. And I know from looking at your services, working with you in the past, that retirement planning is a big focus of yours. What are some of the biggest challenges people face transitioning from earning a paycheck to now relying on retirement savings?
That is huge. When we are working, we're putting money away. We know that if we don't touch it, it goes up and down like a bobber in the ocean. But when we retire and we have to start using our money, all the strategies and products that we now start using to use our money are different than just the accumulation, what I call the accumulation stage. The accumulation stage, from the day that you start working until the day you retire, you're putting money away, knowing that the more money you put away, the more money you'll have later, the better lifestyle you have, the more options that you'll have, the more financial independence you'll have.
Yep.
But when it comes to start using that money, we've got regular money, we have tax-deferred monies, we have tax-free monies. And just like a plate that has dividers on it, this money can't touch. It's got different tax rules, it's got different taxation, and that's where my specialty comes in. When we actually start using our money and we want to put it to work for us, this is where I take a look and say, okay, out of all the things that we've managed to buy over our life, what are we going to use now? What are we going to use later? What are we giving away? What's left over that we need to move into one of those three categories so that we can have the most tax efficient, most income effective retirement possible and go out and do those things.
Absolutely. What do you see as some of the common mistakes that retirees make regarding taxes, and how can they better prepare for that?
The two biggest mistakes I see is that people know that they have this tax problem and they put it off.
Yeah.
Instead of at age 59, when we can first start actually using our tax retirement monies, 59 and a half,
right,
without our 10% penalty. A lot of people just know that it's a problem and push it to the side and wait till now age 73. So required minimum distributions, if we go back to 2002, used to start at 70 and a half. In 2020, that was moved to 72. In 2022, it was moved to age 73. And this is where the governments are changing the rules all the time, very slowly, very insidiously, kind of under the table, that people are not aware of. But this is where I sit down and we'll take a look at, we have this forever taxed money. How do we move this into never taxed money? And then again, how do we come up with an income plan that allows us to go out and have fun? The one thing I've learned, life is too short. We never know when the music's going to stop. So take the pictures, go on the family trips when you can.
Absolutely.
One of the biggest transitions is going from that go period of your life to that slow go period of that life to now the no go period of your life.
Yeah.
So we want to make sure that they're properly funded and that the death of one spouse doesn't have a huge negative impact on the other.
Right. And is there any, when someone comes to work with you at first, obviously I understand you got your process where you're going to go through these things that you just mentioned to get an understanding where they're at, how to get them to where you'd like them to go. Once they're already an established client, how often do you suggest you meet with your clients? And the onus, if we put the onus on the client for a second, just to give them something to be proactive about, how often should they be getting in touch with you, or are there any situations, triggers, as I call them, in their life that might occur that would be a reason why they would come to you to do a review of their accounts and what we've laid out? Like how walk me through, how often that should take place and what people should be looking for.
There is no general rule. Usually I like to leave it up to the client. initially for the first year or 2 years in order to get things together, how often you want to come see me so that you make sure that we're on plan, we're on the same page. I kind of leave up to them, but it also depends on the type of investments that they have. So having been in this business for 32 years, I have two companies. I have one company that works in the market with liquid Charles Schwab liquid accounts where we've got like blue chips with dividends. One of my favorite accounts for retirees. We want the blue chips with dividends as kind of our core account. And then we can put alternatives. We can put different types of tactical programs around that. But those people need a little bit more touching than, say, insurance products where they only change really once a year.
Right.
But if someone needs to come in 3 or 4 times a year, the first year, just to make sure that everything's okay, I think that's fine. I don't have a problem with that at all. The whole reason I'm in this business is for people, and I find people just interesting and love to sit down and talk with them at any point.
Yeah.
But that's really driven by the client and the type of investments that they have.
Yeah, that makes sense. I know that legacy planning is a key focus of your firm. Why is it important for individuals to have a solid legacy plan in place? And what are some often overlooked aspects of that process?
Well, this is where a lot of people just really don't understand the difference between an advisor that is really just working in what I call the accumulation mode. Give me the money and let me grow it, versus someone in the retirement that says, okay, what is our income going to be? How much of our money is at risk? How much of our money is safe? What are we going to use to create income? What are we going to put our money in that's liquid and available for things that we want to go, I want that, I want that. And this is where it's kind of dividing it up. One of the tools we use is called the rule of 100. It basically says if you're 65 years old, 100 minus 65, 35% of your money could or should be in the market because of human longevity and higher interest rates. However, as a general rule, 65% should be in things that are relatively safe, that are not going to be affected by a market crash, especially with our retirement money that has no cost basis. This is where a lot of people really don't understand how different retirement money is, how it's taxed and how it can be used against you, and have a program where every year we take a look at our income, we take a look at the tax brackets, and then we take a look at how much money can we move from forever taxed to never taxed each year and still stay in that tax bracket, but maximize. For example, let's say that a husband and wife have about $75,000 of gross income coming into the house. Well, our standard deduction this year is about $32,000, or a little bit more than that if they're both over the age of 65. So we take that $75,000, we subtract our $32,000 standard deduction. Now we're sitting at $43,000 of taxable income. Well, the 12% bracket goes to $94,000 this year. That means that if you're at 42, you could actually take $50,000 of forever taxed money, put it into a Roth account, and only pay 12% on that $50,000. Those days are numbered, and a lot of people just don't realize the legislative risk. They also don't realize that we're in the third lowest tax bracket in the history of the United States. The only time taxes have been lower is during the Depression and during a couple of years in the 80s. But right now, taxes are on sale and people are not taking advantage of it. And that's the biggest thing I need to get out there and tell people. Yep. Listen, if you're in that situation where you're at $75,000, you're now at $42,000 of adjusted gross income, you've got $50,000 that you can maneuver at that 12% tax break. And again, those days are numbered.
And I was going to say, those days are numbered. Do we have an exact date of how many days do we have left before they're numbered?
Yes and no.
Okay.
So right now the answer is yes, because the current tax rates that were put into effect in 2018 will expire on December of 2025. So tax year 2024, tax year 2025, we know what we're operating with. But at the end of 2025, the current tax system we have is going to go away. And something new will have to come in its place. And if you look at our debt and the way things are going, it is my opinion that taxes will have to go up to help cover some of these expenses.
So what are one of the things that people could do right now? I'm sure there's a variety of things, but if you wanted to give a tip or two of what people can do today, people in retirement who, as you said, you just depicted, have this opportunity to take advantage of this gap, so to speak, in the tax bracket. What is, like I've heard Roth IRAs,
Yes.
are the hot. That's been like a hot topic, and I'm not in the financial planning industry. I'm obviously in the mortgage industry, but I've rubbed shoulders enough with you and others that I've heard that. Talk to me about that. How a Roth IRA right now, if this is still an opportune time to take advantage of a tool like that.
And again, because of the fact that our 12% tax bracket goes all the way up to $94,000 a year of adjusted gross income, which actually means if we add our $32,000 standard deduction, you can stay in the 12% interest tax break, even if all of your gross income is $120,000 a year, you're still in that 12% tax bracket. Anything under $120,000 a year creates the opportunities now that we can use to take that forever tax money and move it into a Roth. The other biggest mistake I see a lot of people make is if they're in the 22% tax bracket, embrace that 24% tax bracket. The 22% tax bracket tops out at about $190,000, $192,000 a year, but that 24% tax bracket goes up to $380,000 a year. Those days are very numbered, especially if you're under 65. One of the changes that occurred in 2018 that a lot of people are not aware of is now the Medicare. The tax on Medicare, it used to be the same for everybody regardless of income. Now in 2018, we have a thing called IRMA. And IRMA says that if you make more than $206,000 married or $103,000 single, now your Medicare payment can be somewhere between $174 a month all the way to $560 a month, depending upon your income. 2 years ago.
Wow.
You sell a house or you take a lot of money out of your IRA, now your Social Security payment for you or your spouse could go up depending upon the level of income.
That seems to me to be a very important aspect. That do you think the average consumer, and that's one of the reasons we're here, and hopefully people will hear this and we can raise some awareness, but is that something the average consumer, average retiree would come across just in their own research?
Not until it happens.
Not until it happens.
Believe me, I've got several clients. One client took out $150,000 out of his IRA to put down on his house so that he didn't have to pay the PMI.
Yeah.
His wife's Social Security, because he was actually under the Social Security at the time, but his wife's went from that $165 a year, which was last year's number, to $430 a month for an entire year. Well, that's an extra $3,000-$4,000 of tax that he hadn't planned on that actually occurred because of IRMA and the Social Security tax.
Wow. Yeah. Yeah. So, insurance. I know that you provide various insurance solutions to your clients as well. How do you guide clients in just selecting, between different life insurance policies, and what role do you see these policies playing in the broader financial plan?
Okay, when it comes to the insurance side, there's really two products that are dominating in the retirement sector, and that is the annuities, which I do use indexed annuities. Indexing is a type of investment that really wasn't available in the past to the private individual, where we actually use bonds and options instead of just putting our money into the market like a bobber. So in effect, what it does is it limits our growth, but it puts our money in a situation where it either goes up or it goes sideways. We eliminate loss. And this is where a lot of people just really don't understand the technical aspects of indexing and how in the retirement stage it creates a huge safety net for our monies when there is a big market change and there is a loss. It actually even works to the advantage, because each year with indexing, let's say the market is up in 2020, the market is sitting at 4,500. It takes a 35% drop or a 30% drop and it drops down to 4,500. Well, what happens is when you have an anniversary, you've now gone sideways and not made anything, but now you start at the lower number. So as that index, like the S&P or the Bloomberg, starts to rise again and come up, you start making money from the bottom. You don't have to wait for it to get back to where it was.
I see.
And that is a huge advantage when you're a retiree. Again, I don't mind limiting some of the potential growth as long as we know that we're going to have income for the rest of our life. So that's one of the things that the index annuities now do. And because of the fact that 10,000 people a day are turning 65, the competition created for retirees' money has never been more crazy or just more competitive. So right now in the United States, one of the things that's going on is our number one company for the annuities, Allianz, and the number two company, Athene, have now been fighting for market share. And the bonuses and the products that are coming out because of this competition are now to the point where they are creating very competitive types of income that you haven't seen before. So normally with $100,000, I could take a couple that had $100,000. I would start an income of roughly 6% and then have that guaranteed for life. Now that number is more of a 7 or 8%, where you can take $100,000 at age 70, turn it into an $8,000 a year income stream that will last until the day you pass away, even if you run out of money.
Wow. Is the consumer feeling any of that competition? Like, are they also these companies that you said, you know, the consumer is getting a lot of attention, if you will, from these other, how are they feeling it? I mean, are they getting advertised? Are they getting hit? Getting to my point, is this doing good for consumer confidence in this regards, or is it swaying them the other way to maybe not look into some of these products because of this competition? Like, help me understand how that's trickling down to the consumer's mind.
Right now, for the consumer, I feel bad because there is so much conflicting information out there.
Yeah.
And it really boils down to who are you working with and what kind of licenses does that person have? Does that person even have the ability to talk to you about some of the safety products? Or are they just strictly selling from like a broker mentality where every solution is a broker solution?
Yeah.
But the crux of it is just there's so much conflicting information out there. There's good products and there's good products that can be used wrong. And this is where you really need to have a specialist in the retirement area, because your normal broker is not going to say, hey, we have to have a required minimum distribution plan. We have to have an income plan. We have to have a legacy plan. Let's bring all your beneficiary documents into my office so that we can look at the beneficiaries. It's unbelievable how many cases we study with Ed Slott. In fact, last week we had one where the guy had left his ex-wife on as the beneficiary of his life insurance. He's remarried. He never changes the beneficiary. The company sends him information going, hey, you have to change this, And he dies before he changes it. And guess who gets all the money? Not the current wife, the ex-wife. Now, whether or not that was his plan, it's hard to say, but that was the reality of the situation. $1.3 million that she thought she was going to have for her financial independence for the rest of her life ended up going to an ex-wife in another state.
And is that partly to, like you said, is that partly due to the fact that that case didn't have someone that was there managing the account and obviously advising, doing annual reviews and such to keep that consumer up to speed and ensuring that if there have been any changes in the estate that, you know, they're making the appropriate changes to, to direct his wishes. I mean, what is that? Is that what happens in some cases when you go with like a broker? I don't know if that would be the right way to depict this, but if you go, and I don't want to single out our brokers out there,
correct?
But just trying to get down to how does that happen?
Well, again, a lot of people will put off putting together either their will or their trust because it involves tough, hard decisions.
Yeah.
But this is where the difference between what I call the normal financial advisor that's just an accumulator, let me take your money and grow it, versus someone that says, okay, now we're retiring. How much of our money is regular money? How much of our money is tax deferred? How much of our money is tax free? Which order are we going to use them in? How are we going to tap them? What monies are we passing on? For a lot of people, legacy is not an issue. We don't have any children. We want to work it out so that the last dime we spend or the last check we write bounces to the undertaker.
Right.
So that in itself is a plan because it's a lot harder to spend everything than most people are aware of.
Yeah.
But that's where reverse mortgages come in. And they're a perfect fit for, I've got so many people that own their house, have their house paid off, but they have really no heirs or no one that wants that house. Well, there's $300,000-$500,000 of equity just sitting dormant in that house, and it's not growing, it's not making any money. So the fact that reverse mortgages are available and the fact that now they're much better controlled in that every company now has the fixed rate, they have the variable rate, they have the line of credit, they have a cost of living allowance built in that a lot of previous reverse mortgages didn't have, so that the older reverse mortgages got a really bad name because once you did it, you were kind of stuck. The newer reverse mortgages do not have that same type of what's the word I'm looking for? They don't have that same type of inflexibility. You have a lot more flexibility with today's current reverse mortgages. If you want to sell and go to another house, you can. Generally, I tell people if you're thinking about moving, you might want to hold off on the reverse mortgage. But a lot of people are not aware that you can buy a house with a reverse mortgage. And so I've actually sent a couple clients your way. I know there's one right now looking for a house in Desert Shores. She's a little upset about the price of the house is in Desert Shores. But that's her kind of her dream thing, and she wants to do it on a reverse mortgage.
Yeah. And I'm glad you brought that up because I want to pivot to just your thoughts on housing wealth, just in general, housing wealth and in retirement, of course, at that stage in one's life, if this is for many, the house that you're living in long term, or perhaps for the rest of your life, you're sitting on this housing wealth that you accumulated all these years. And for those who are either A, just keeping it in the ground versus those who are actually somehow extracting it, whether it's a reverse mortgage or other means, just speak to me first, just in general, your thoughts on incorporating housing wealth into the retirement plan.
For a lot of people, the money that in your house was never really an asset that was available prior to be used in a very logical way or a very effective way. So with these reverse mortgages now, we now have a tool that allows you to use that asset in a way that doesn't come back and bite you later when you're older, because again, there's never a payment due until after you pass away. And the way that the reverse mortgage is structured, there's always equity left in that house because of the difference between the value of your house and how much value you can tap into that. But I tell my clients, if using a reverse mortgage would change your life and allow you to go on extra trips or take your family to Disneyland once more a year or to go on bucket list items, then use it. If it doesn't, then that's not a tool that you have to use, and you can pass those monies on to a different generation or your heirs if you want. But it is now a tool that can be used effectively with the right products.
Yeah, and speaking of that, obviously, you touch on a big thing, that is often overlooked, which is that emotional component in retirement that is hard to put a price tag on. The peace of mind, the enjoyment of being able to now, at this juncture in my life, while I'm in good health still, hopefully in my mid-60s, mid-70s, what have you, that now, if not when, this is the time to do some of those things. Maybe, like you said, take that trip to places you've never been to, et cetera. That's always been something that, like I said, seems like it has been often overlooked because you can't put a tangible price tag on what that equates to, right? But on the other side, with strategies, what have you seen in your experience in working with cases? Because I know you have worked on a few cases with reverse mortgages in the retirement plan. What have you seen in terms of helping to supplement income and further increase net assets and maybe in some cases decrease income taxes by using different strategies where now you have this additional bucket of liquidity that you and your client can tap into to strategize on how to best, again, save on taxes or just be more effective with the plan.
Well, one of the things that the government has done for us by making reverse mortgages a reality and putting them into place is also it's all tax free. It's not reported. Any of the money that comes in on a reverse mortgage is not added to your Social Security tax. It's not added to your income. It's not used against you. And that is a huge tool because it's tax free money, which is my thing, tax-free money. I'm really big into either Roth conversions or these newer policies called IULs. The danger here is just like on reverse mortgages, you've had so much bad information put out there with people saying, I hate reverse mortgages. And the fact that there were legitimate reasons in the past where some of the reverse mortgages wasn't as beneficial because of the laws versus what they are now because of the new laws and the new protections put into them. They're a much better tool for creating that income. Taking money from the reverse mortgage and putting that into something that will create a lifetime increasing income that allows us to go out and have more pictures and have more trips and more lunches. That's what life is about. That's what we've saved for those 40, 50 years while we worked. That is the whole reason. And the reverse mortgage is a great tool that people can use for either making their mortgage go away. If you've got $1,000 a month mortgage and we can make that $1,000 a month payment go away, well, that's $12,000 a year of income that we've created now that we can use. So again, just having someone who's taking a look at and saying, again, what tools are we going to use now? What income are we going to use later? It's a little bit different than just give me your money and let's make it grow. Now we're looking at a lot of people that don't have pensions. We want to create something like creating their own personal pension that gives them the income to have the financial independence to do the things that you want to do.
Right. I think one of the reservations that people have with reverse mortgage when it comes to looking at the total retirement plan or the estate plan is they believe that they are not going to be able to leave anything behind to their beneficiaries, or they're going to leave less behind. And a lot of times it seems like they're just focused on the equity piece, because naturally the equity with the reverse mortgage in many cases is going to come down over time because you're obviously utilizing it, and many people aren't making a payment towards the mortgage. That's one of the advantages of it, like you said, free cash flow to apply to other areas in your life. But speak to me about your thoughts on, is that a little narrow-minded and just looking at the equity piece as opposed to taking a step back by the consumer and seeing how this tool plugged into the retirement plan can potentially increase the overall net assets of the plan, where in the end, you may not leave as much home equity to the beneficiaries, but through other strategies and means, you might leave a greater legacy behind, which I believe that's contrary to what a lot of people believe with the reverse mortgage. They just automatically believe that I'm going to leave less to my beneficiaries. Some might be okay with that because they're looking at their own retirement. Right. But I think there's a large percentage of the population out there that is a reservation for them on why they do not look further into this product, is they automatically believe that I'm going to leave less to my beneficiaries. There's no ifs, ands, or buts about it. What are your thoughts on that?
So what I kind of look at it, it's an old-fashioned mentality because a lot of people are just not aware of some of the new tools and the new products that we have to leave money to our heirs. And that, as you said, they're just kind of using, if I do a reverse mortgage with my house, now I'm taking money away from my children. But there are many other ways to take those funds, especially through life insurance or through legacy funds. One of the things that I've done lately to change my presentation or the way I work with clients is to find out if that is an important feature, but to create a legacy fund that we say, okay, here's a fund that we are going to pass on to our beneficiaries. If we need it, it's there. But now it allows us to take our other tools and use them much more effectively, because now we're leaving tax-free money for our children, either through life insurance or through other types of insurance products that are going to come out tax-free, versus this piece of equity now that if you passed away in, say, the year's 2008, you've got relatives on the East Coast. Who's watching the house as the price goes down? It's not for sale. Now you've got to worry about the integrity of the house. You have to have someone take care of it, make sure that no one breaks into it. A house can actually be more of a burden than an asset, depending upon the political or financial environment when the year you pass away. Now, if we knew what that looked like, it would be a lot different.
Right.
But this is where we can take a lot of that anxiety out by using the reverse mortgage and putting that into things that are guaranteed, that are going to be there no matter what the economy is doing.
Yeah, great point. Healthcare, we touched on it briefly a little bit ago, but obviously with the rising cost of healthcare, how do you help your clients navigate that piece of their retirement plan?
That, for most people that look into either long-term care, there's the one tool is just like life insurance. It's based on the age that you buy it. If you are in your 40s or 50s, it's reasonable, it's cost effective. But if you start looking around in your 60s or 70s, we're talking $400, $500, $600 a month in premiums. There are ways now through the newer products. Again, the competition created by 10,000 people a day turning age 65 have now, we've got products both in annuities and in life insurance that provide care for home health care for free as a rider or as either a rider that you can add or one that's already built into the product. But there are certain products that we can use now that give you that home health care basically as a free benefit. And so now we can save that $500-$600 a month and have products that will be there if we need the home health care.
I think that's an important point, because I think a lot of people I've spoken to who are in retirement already, they're in their mid-60s, mid-70s, who, like the majority of America, do not have long-term care insurance, right? There's only a very small percentage of Americans, unfortunately, that have it.
Yes.
But the majority of us are probably going to need it one day, right? But I think what, at least from my experience and what I've read a little bit here and there, is that there's this feeling that it's just not attainable financially, especially for those who are living on fixed income and maybe have a modest amount of savings or have savings, but they don't see the path of being able to afford it. It sounds like, from what you just said, that there is some options and some possibilities on how one could be able to afford long-term care insurance, not to even bring in the equity piece, a home equity, but I know for some of my clients as well, that has been one of the objectives of tapping into housing wealth and bringing housing wealth into the retirement plan, whether it be a reverse mortgage or another tool, to be able to liquidate that asset and be able to afford things like long-term care insurance.
This is where the person that's going into retirement has to have the ability to rise above the noise and I hate to use the word fake news, but to avoid the traps of just the old mentality. Get with somebody that's using these modern tools, these modern annuities, these modern life insurance policies that provide that type of home health care benefits that are out there. There are a lot of new products, again, because of the competition created in this field, that do offer it, that are very good. But you have to be able to work with someone that's actually in that business, because they can be complicated and they can say this. Okay. So when it comes to the products in the insurance fields, this is where you just need to have somebody that's aware of what you're looking for and being able to match that up with the products that are out there.
Right. Understood. That makes a lot of sense. Something that you have brought up, something called generational vault. Can you explain how generational vault can help families manage their financial info more securely?
Well, generational vault is one of the benefits of working with myself and the companies that I'm affiliated with. It's a encrypted website place that you can go to that actually has 2 rooms in it. So one room I share with my clients where we share the policies that they have, the meetings that we've had, and we keep a history of what we've done together. Then it has another room for data that people can put in their wills, their licenses, their powers of attorney, so that if they are away somewhere and something happens and they need access to it, it's their vault that they can go into from another location that's 248-bit military encrypted that allows them to have access to their documents when anywhere they are.
And I assume you put this together, or what, is this something you put together yourself, or is it a service? Okay, but I assume you brought this into your process, into your planning, because there's situations where people have not been properly organized. Day comes, they pass away, the beneficiaries come in and they have no idea what's going on. I'm sure that happens from time to time.
Probably more often than not.
Yeah.
And so having one place for all of that information is huge, and it really helps the beneficiaries know that there is a place where they can go, they can get the policy numbers, they can get details of the policies and who they need to contact in order to take it to the next step and start doing the transition from the assets from their parents to themselves, and that works.
Yeah, that seems like such a good time saver and just an effective way to be able to communicate one's directives, their wishes in a very organized manner to save time and money for the estate and the beneficiaries.
Very much so.
Yep.
A lot of people just don't realize the cost and the time involved in going through probate.
Oh, yeah.
That turns into a dirty 4-letter word.
Yep.
And there are certain things, there are, again, different types of money have to have, the money has to be left different types of ways. We can't put our IRA money into the normal family revocable trust without it all being taxed completely different in a very non-efficient way. So again, the beneficiary forms, sitting down and taking a look at the different types of money, the different assets, and making sure that the beneficiary forms are not only right, but they're right for that type of money.
Right, sure. We obviously have had a lot of volatility in the market, right, in the last couple of years or so. For people in retirement, and I think about them more so than our younger folks, because the window for them is obviously much shorter in terms of being able to rebound from the ups and downs, and more so the downs of the market or the volatility of the market. How are you helping your clients to stay financially secure during those periods and prepare for the unexpected, things that come about in life?
The foundation for that really comes with an income plan. Knowing that we're going to have a certain amount of income regardless of what the market does, and being able to have that set. Then by having certain assets that are more liquid or more available, we can choose whether or not we want to use those assets or buy things depending upon the financial environment. But it really comes with having a guaranteed base of income that's coming in every month that's going to meet the needs. The biggest anxiety is created when we have a pot of money, but as we use it, the balance is going down to zero, knowing that once we get to zero, we're done. That creates anxiety, knowing that we have a certain income coming in every year for the rest of our life until the day that we die that meets our needs, and now having money left over for optional alternative things. That is where the stress-free comes in, knowing that we're set, knowing that we don't have to worry about whether we need to buy medication or pay our electric bill.
Right.
That comes down to an income plan, and that really makes the difference between those that are stressed and those that are not.
Right. Understood. With that, going back on the reverse mortgage product, do you think that this is an underutilized tool from your experience, from what you've come across? Do you think that not enough retirees are understanding this product and are putting this product into place to take care of some of these issues and provide some solutions to some of these problems that people have in retirement?
Absolutely. The amount of negative information or the amount of bad information, both in reverse mortgages and insurance products, are keeping a lot of people from finding that stress-free retirement that they're looking for. And again, it's just a matter of rising above that, finding a person that you can trust for reverse mortgages or for creating an income plan, and making sure that we take care of that in a way that benefits us and with our goals.
Yeah, understood. We've touched on a lot. What haven't we touched on? Any thoughts while we're rounding out here on any items that you feel are important today for the retiree based on what we've got going on in the market? With we just kind of came off the heels of an election. We're going to have some changes, obviously, in the White House. With all of that being said, anything that comes to mind that we haven't touched on today that we should get out there to our retirees?
I think the biggest thing is to find someone that you trust, either for reverse mortgages or for retirement planning, and to take a look at the options that are available today. The tools and the options that we have available today are so much better than they were even 5 years ago. The different reverse mortgage options that we have now that the federal government's got in and regulated are a lot better. So a lot of that negative publicity that was out there before that was somewhat true is not as true today. And people need to say, hey, wait, let's just stop listening to all the negative. Let's go to someone that's really in this field and tell me, what are the options that I have? How would they affect me? How are they going to benefit me? And if it does work with me, let's go do it and let's create that better lifestyle.
Yeah, agreed. I mean, and like you said, with insurance as well, these roadblocks that people have in front of them for whatever reason, whether it's, like you said, whether it's old stigmas or what they heard from the neighbor, it's unfortunately a real disservice to a lot of people out there who could benefit from certain products, whether it's in the insurance aspect or with the reverse mortgage, that could really change things around, right? I mean, it could really be a solution to a lot of the problems that we're having in this country right now in retirement. So that's, I know what you're doing out there with raising awareness with what you do and vice versa with what I'm doing out there. But there's still a lot of work to be done, right?
No, for me, most of it is just really getting out there and saying, hey, let's not put this off. Let's go talk to somebody, find out what your options are. The options, again, that are available today are completely different than what they were even 5 years ago. So get out there. Don't just sit back. Don't be afraid. Find out what your options are. Find out how they're going to affect you and start using some of the new tools that are available today because of the new legislation, the competition that's out there, and go out and live life.
Yeah.
Find your passion, help people create a better life.
Yeah, well said. How do you start your process with clients? So if someone wanted to work with you, how do you typically start that engagement? What do they need to be prepared or have prepared before they meet with you? Any tips that you can give someone who is thinking about maybe reaching out to you, working with someone like you? What should they know going into it, or
as a retirement planner, I want to take a look at all the things that you've bought over your life and say, okay, how are we going to use this? How are we going to use this product? How are we going to use this? And in most cases, there's a lot of things that people have bought in the past that they have no idea the different advantages or disadvantages, how to use it, when to use it. And it really, the thing that upsets me probably the most is when someone comes in my office at 72, 73 years old, they've just bought something, but they have no idea how they're going to use it. Well, at 72, it's not a buy and hold strategy anymore. It's a buy and use strategy. So just making sure that we have the right tools, that we're using them correctly. And a lot of people just really don't understand that. It's about making sure that you have your money in the right places, you have the right beneficiaries listed, you're using them correctly and to the maximum value.
Yeah, that makes sense. How do people get a hold of you?
Griffin Advisory Services. We have our website, ggriffin.com, or just give us a call. We're in the phone book. My office is over in Desert Shores, right next to the restaurant Marche Buckus. I do a lot of my prospecting through seminars, the dinner events, only because I have found that once people sit down with me and they've listened to me for about an hour and 20 minutes, they may not like me, but they definitely know that I know what I'm talking about.
Right.
So I need to create that level of expertise in a very short way. And it's a lot easier to do it with 15 people sitting down for an hour than it is try to do it one-on-one for 15 hours.
Right, absolutely. Do you have any seminars coming up, or how would people find out about your upcoming events and seminars?
The last two seminars that we have scheduled for this year are next Monday and next Thursday. So the 11th of November and the 14th of November at the Bonefish Grill on Charleston, right by Durango. Charleston and Durango, that Bonefish Grill is where we use.
Okay.
I was actually using that restaurant back in 2006 when it was actually under a different name, but it's been a great location for us. It's very central, and that way people can come in, they can listen to me. There's no commitment, there's no pressure. Just come in, listen to me, and if the things that I say are sounding good, then let's sit down and talk. But if in terms of coming to my office, if you have policies, bring those, because we have to read them. Every policy is so different. Even if two people had bought the same policy a couple of years apart, there's going to be vast differences in the details of that policy.
Understood.
So bring them in if you've got any type of long-term care policies, any type of disability, any type of life insurance. Let's see how we can use those. And if we're not going to use those, what can we do with that money to put it in a better place?
Right. Makes sense. Any last thoughts before we wrap up?
Enjoy life, find your passion, talk to someone who's a leader in that field of either retirement planning or reverse mortgage. Find out what your options are and don't be afraid to go for it.
Excellent. Greg, thank you for coming on the show. Appreciate it. If you have any questions for Greg Griffin, as he already mentioned, you can reach out to him directly. Also reach out to me, and be happy to field any questions and relay them over to Greg. And as always, if you have any questions regarding retirement mortgages, reverse mortgages, reach out to me directly. Thank you for tuning in, and watch out for our upcoming episodes on Retirement with Rick.